Hello, and welcome to this episode of the Laundromat Millionaire Show, sponsored by HM Company at DrainTroughs.com. Today, it's just going to be me and Dave. We're going to be talking to you about a very hot topic, due diligence. What is it that you need to do when you are looking for that first or maybe additional laundromat that you're thinking of investing in? How do you figure it out if it's the right place for you and a good place to invest? How do you figure out how much is it worth? And what are those red flags? So we're going to be talking about all of that in this episode.
Yeah. I think the first thing I want to point out to people is this is something that I think throws a lot of people off, is very confusing, but it shouldn't be. So I'm hoping that we're going to go in depth and kind of the 12 steps that I take, that I recommend that you take, and talk a little about each one. But maybe I can kind of break it out and fragment a little bit for you too, so it's not quite so intimidating, because I think a lot of times people are intimidated by this big bad monster and they don't know what to do. And am I missing something? Am I misreading something? So we're hoping to kind of simplify what due diligence is and to break it down for you and how we do it here at Queen City Laundry. And hopefully this episode will bring you some value. Also pretty cool, Carla, before we get into this episode, you know what this is? This is episode number 100.
Oh, yes.
Which is pretty cool. Pretty cool indeed.
We're into the 3 digits.
That's right. We've been at this a little while, and when I first came up with this crazy idea just on our couch, I thought, I think I'm going to do a podcast because I think I can bring people some value. And then I looked at you and was like, I think you should do that with me. And you're like, really? What? You want me to do it with you? What do I know about laundromats? I'm like, I think you know more than you think you do. First of all, Carla, it's been really fun doing this with you. I don't know how long we'll do this, but no end in sight at this point. So we'll see how long it goes and how long our family cooperates. But I can tell you that we wouldn't have made it to 10, let alone 100 episodes. If it didn't help you guys, it didn't bring you value. We didn't get, we didn't get good feedback from you guys. And although vanity metrics aren't that important to us, it is pretty cool to see that it's grown from not being a thing to having thousands of people watch this every time we release an episode. So pretty cool. We just want to thank you guys for supporting the show. And if I don't say it enough, we really appreciate you guys. But do us a favor. Click that like button, click that subscribe button. That lets you get alerts when these episodes come out. And do us a favor, share these episodes with friends and family that are in the industry, because these are free. It doesn't cost anything to watch them. And if you know people that maybe don't know about our platform or about the show, part of the reason we do this show is just to bring value. We don't expect or get really anything in return. We just want to help elevate the industry. That's our mission with the Laundromat Millionaire platform. So thank you guys for supporting us. We'll see if we can hit 200.
Yes. And before we get started with the episode, one last plug is make sure to come and check us out at the Clean Show.
For sure.
That is in August 23rd through the 26th, I believe. So at the end of August, make sure to come see us down in Orlando. We will be around at different booths, but also our marketing company, Launder Boost, will be having a booth there, booth 1067. So check us out there. We'll be there quite a bit as well. Maybe even giving away some books and doing some book signing too.
Yep.
So look for us there. But let's go ahead and get started with today's 100th episode, and that is on due diligence. I think of the due diligence as the inspection.
Don't take anything for granted. I'm telling you, if it's important to you, make sure it's in writing.
Some laundromats out there do not even keep financial records.
Yeah. Just know what you're getting into, and some of these things I've been burned by. All right, so welcome to this episode, guys. Before I actually even jump into the 12 steps of due diligence, which it just occurred to me, 12 steps, isn't that like an alcohol thing?
I think that is. This isn't the same.
Hopefully this isn't the same. But anyway, I don't know how that's the 12 steps that I use to do due diligence. Before we even get into that, I found that through all of my coaching that a lot of people in the industry, as they're approaching this process, they don't even really understand. No one's ever explained to them the process of what due diligence is for. What's the purpose of it? So before we jump right into it, I don't really want to take that for granted. When you're looking at a location that maybe is for sale or not for sale, and you approach the owner and maybe they have a number on the store or they never thought about selling before, that's the beginning of the process. That's what I like to refer to as discovery, right? And let's say hypothetically it's listed with a broker and you make an offer, right? What a lot of people will do is they'll go right into the process of due diligence without even realizing that what they're they're doing. And what they do is they'll go to the broker, they'll go to the owner and be like, oh, well, if I'm going to make you an offer, I need to see your taxes. And if I'm going to make an offer, I need to see your P&L, and I need to know this, and I need to know that. And if you haven't ever gotten balked at that, you probably will, right? Because that's not really how the process works. The way that it works is typically if it's through a broker, they're going to have some very, very high level, very loose information around the profitability of the business, but it's typically not even going to include the P&L. It's just going to be like, oh, the gross revenue is this, the net profitability is this, some very basic numbers around the business, and then an asking price and maybe a location, an address, and a few pictures. And that's the starting process. That's what I call the discovery phase or the offer phase. If you reach a point where you're trying to get into due diligence and they won't let you, it's because you're getting the cart before the horse. So I just wanted to explain that to people. The way the process typically works is you take that very high level information. Usually you'll have an address and a location and things like that, and you can go in and take a peek at it if you want. But what ends up happening from there is you either make an offer or you don't, right? A lot of people think there's like some big magic bullet to this. It's like, okay, if this store is worth what it's worth, I'm going to make an offer based on you're asking 500, you do 100,000 net operating income per year. Yeah, I think it's worth 5x because I know you told me the machines are 2 years old or whatever. And so, yeah, potentially I think it's worth 500,000. You're asking 500. I'll make you an offer of 500, right? You typically fill out like a 1 or a 2 page LOI, letter of intent, which is typically non-binding, and it should be non-binding. You can put all these contingencies in the LOI that says, oh, it's pending this and it's pending approval of financing terms. And you can put all these vague language in the LOI to give you all these outs if you decide to get out. But that's basically a legal handshake agreement, for lack of a better term. That's at that point when you've both agreed to a purchase price, you've signed an LOI, you've agreed to move forward in the process. A lot of times the person you're purchasing the store from will ask for proof of funds. Before they will shift into due diligence, they will ask you for proof of funds. So if you're going to pay cash, if you're going to finance it, do you have a pre-approval letter? Like all these different things before they're going to hand the keys to the kingdom over to you, right? Things like very valuable things like tax returns and P&Ls, because they don't want any mom and pop just walking up and getting their P&Ls. Their competitor could in theory do that if this was all just through email or whatever, right? They want to make sure that you're a legitimate buyer. You're not a competitor that's doing investigative work and things like that. They also, during the discovery and the due diligence phase, a lot of times the owner will also be very hush-hush. And it really makes sense if you think about it. They don't want you in the store a lot, and they certainly don't want you in there telling their employees that, you know, you're going to be the new owner in 60 days. A lot of times they don't even want the employees to know that the business is for sale. It's why most businesses don't have a sign in the front window or door that says for sale, is because they don't want the employees to leave. So that's just a little bit of kind of behind the scenes. Before you even get into due diligence, I've talked to coaching clients that are like, oh yeah, he wants me to make an offer and I haven't even seen his tax returns yet. And it's like, well, you don't understand the process, and you're probably causing them to balk at you as a buyer, even if you are a legitimate buyer, by just not knowing the process. So just wanted to throw that out there real quickly before we get into what is due diligence. So the truth is, what due diligence is, it's after that. Right? Once you've signed that LOI, you've made that agreement, you come, and by the way, after due diligence, it's very common to renegotiate. So we can get into that in a minute too. But just because you offer 500, you get into due diligence, and the point of all of due diligence, these whole 12 steps, is simply to verify that all the things that they told you were the case are the case. And as a general rule, when you make an LOI, a lot of times what happens is, you make an LOI and then it gives you 45, 60 days, whatever, for due diligence. You can bump that out more. You can bump it out eternally if you need to. I always tell people you should bump that out until you get the answers to all your questions. The point of due diligence is to go through this 12-step process, and until every question has been answered and you have been able to confirm to a level that you're comfortable with that all these things are true. It does make this, and the store does this, and the debt is this, or whatever. Until you get to that point, you should just keep delaying the closing. And by the way, if you can get through due diligence in 5 minutes, then you can close the next day too, right? There's nothing says you can't do it sooner. Once you have the information, this due diligence phase is basically a phase where we're verifying that our offer is still valid. And typically when you go through the phase of due diligence, you learn some good things and you learn some bad things, right? That's just usually what happens. And so you typically have a second round of negotiation.
I think of it a lot, if this helps, I think of it a lot as like when you are offering to buy a home. Like usually they have a certain amount that they list. You are able to look at the home and see what you see, and you make an offer, but that offer is pending the inspections. I think of the due diligence as the inspection. Like, and if you think about it, when someone's offering their home for sale, they don't let you come and do inspections before you put an offer on the table, a signed offer. So the letter of intent is kind of like a signed offer on a house. It's saying, I agree to pay this much pending the inspection supports that there's no issues. And that's kind of like that. Your due diligence is, I agree to pay this amount pending my due diligence doesn't find that what you say your business is doing is untrue. And if so, then I'm going to have to renegotiate. So that's what makes sense to me.
That's a great analogy. I mean, the only thing I'll say is that, I mean, it's more involved. It's more in depth than that. A residential transaction, a business transaction are two different things. But that's a great analogy. Let's talk about financing your next laundromat project for just a second. Whether you are purchasing an existing laundromat, building a new store, or just buying a small set of equipment, Eastern Funding has financing solutions to help you on your laundromat journey, just as they have me and Carla in the past. Eastern Funding has been financing laundromats since 1997, and they have helped thousands of owners get their deals done. They are specialists in the laundry space, and their combination of personalized service, expertise, and custom financing solutions makes them the premier lender in our industry. Learn more at easternfunding.com for your next project. Special thanks to the folks over at Eastern Funding for helping us to sponsor this episode of the Laundromat Millionaire Show. Now back to the show.
Okay, so let's get into the steps. So the first step, once you have that letter intent is accepted, you've put in the offer. So now you're doing this due diligence. The first thing is you're going to want to actually get financial support for what they claimed was the state of the business. So things like the actual P&L, the tax returns, the balance sheet, the cash flow statement. And I know Dave recommends even 3 to 5 years, so you can even see kind of the trend as far as what they're doing. Is it growing? Has it plateaued? All that kind of thing. And what are the specific line items for what they're deducting? When they show that net income, what are their expenses? Are they expensing for everything that they should be expensing for? But here's a problem. Some laundromats out there do not keep do not even keep financial records, or do not keep very clear financial records or up-to-date financial records. So what recommendations do you have, Dave, for getting that financial data? What are some workarounds?
Well, first of all, unless they're just literally being illegal in every shape of the word, I mean, they should still have a tax return. Now, those tax returns probably are a lie. You know, the fact that they would lie to the IRS, I don't know why people would do that. The IRS, I don't want them anywhere near my business. So I'll follow all your rules. But the truth is, a lot of times when you look at that, you have to start to compare and contrast, right? What they told you is true and what is probably feasible. And you decide how comfortable you are with that. And I'll give you an example. If they told you it grosses $1 million a year and on their tax return, it only grosses $500,000 a year, like as crazy as this is to say, it is possible that they are taking $500,000 a year and putting it in their pocket and not claiming it as income. Like, that is possible.
Especially if it's cash based, where you can't. Sure. I mean, if it's electronically based, like they're using some kind of card payment system, you can ask for the card payment reports and stuff like that. But
So one of the things when it comes to the financial documentation is a lot of times from the jump, they will tell you, oh, by the way, I said it does this. My tax return is not going to show that. Now, my P&L will. Well, we all know a P&L doesn't get sent to the IRS, right? I mean, you could put anything you want on a P&L, doesn't make it true, right? When you're buying a cash business, which a laundromat typically is, you have to figure out how comfortable you are with those. Okay, it is possible they make $1 million, but I can't verify. There is one rule of thought, which I tend to lean this direction a little bit, which is if I'm paying if I'm purchasing a business based on the net operating income, the profitability of the business, then I need those numbers to be verified. And if you're lying to the IRS, then why do I think you're not lying to me? What I always tell people when I buy businesses is, hey, if you decided to do that, then you already got your money. Right? You already got this business is now worth half of what it would have been worth because you've already taken half of your distributions is kind of the way I approach it. There are people that are like, oh, but I'm not going to pay $500,000 for it, and I still want to buy the business. And so a lot of times what happens is you have to figure out what level of comfortability do you have with what they're telling you and what's actually on paper. Now, that's just with revenue, right? You can look at bank statements, but just because it wasn't a deposit in the bank doesn't mean that it didn't happen, right? So that's one side of it. Now, the good news is on the expenses side, you can verify all that, right? You say your water bill was X. Let me see your water bill. As a general rule, it's pretty common for them to give you 2 years of documentation of all of their expenses. I agree with Carla on the income side, and on the expenses side, I like to see 3 to 5 years because I like to look for patterns. And if you see something drop off or pick up or whatever, okay, well, what happened in there? Did you have a water leak? Did you replace your equipment? Did you start skimming? What happened here? Did you turn down the temperature on your dryers? Like, what's happening in this environment? And when you dig into the numbers, it's really the story behind the numbers that tend to make sense when you look at, utilities are 30% of sales. Okay, well, that doesn't make sense because you have 2-year-old equipment in the store and utilities shouldn't be that high. What's happening here, right? And sometimes that's where the first place that a lot of times having a mentor or a coach on your side that's looked at hundreds of these things specifically for laundromats that can help you navigate that really quickly because those things kind of jump out at people like us.
Yeah, like when they can't verify the revenue they claim because that's not what's on their tax return. Someone who's experienced in the industry might be able to tell you, oh, well, you can look at their water bill, you can look at their electric bill, and that can help you approximate what's reasonable for the amount of revenue,
and
right?
That's usually on the revenue side. That's usually what happens is you have to get to a place where you're approximating that the revenue is probably about what they're basing this on. Now, once again, if they give you all the real expenses and then they say it's making $1 million, but the tax return says it's only making $500,000, but you look at the utilities as a percentage of sales, and the utilities a percentage of sales was 35%. And with 2-year-old equipment, that should be like 12 to 15%. That actually lines up, right? That's actually a confirmation. Revenue must be much higher. That's right. Because if they have old equipment, it could be 35 or 40%. But if they have 2-year-old equipment, there's not a chance in any scenario that it would be that high. And so that actually, you're peeking behind the curtain. That actually confirms that their revenue statement is actually probably accurate. Does that make sense?
Yeah. Another thing with the financial statements are those red flag expenses. So you kind of said, okay, utilities is too high. Maybe that means that the revenue's off. Or maybe, I guess if utilities was too low, maybe they're inflating their revenue even, trying to get a bigger deal or whatever. Yep. What are some other red flag expenses? I know in past podcasts we've talked about the payroll and wages. If you are looking at a laundromat and you intend to have it fully attended and they have no employee wages, then you need to think about that because either maybe they're not attended at all and you're going to be making that change. But what if they have no attendant whatsoever, but it's fully staffed all the time? Either they're not accounting for their own wages or their own money for being there because you're going to have to hire someone to be there, or they're paying people under the table with cash, which is an expense you're going to have legally, even though they're having it illegally. What are some other red flags besides just employee wages that you've seen?
Well, the wages is a big one, but it's really, the big 3 or 4, if you want to call them that, is utilities, which that shouldn't be a big number, but it can be. The payroll is one, and I'll talk about that in a second. The rent is typically one because that's usually one of your biggest expenses. But when it comes to the rent, that's pretty self-explanatory because they're going to provide you with their lease. You're going to look at your lease. They're going to pay $3,500 a month. And once again, if you look at the lease and you see that the lease is 40% of their gross revenue because they're only doing $500,000, well, that's not really sustainable. It's not profitable at 40%. But once again, if that lines up with the utilities and all of a sudden all these expenses are double what they should be, that actually I wouldn't tell them this, but that actually confirms that, hey, their income is they're taking a bunch of cash home with them. Now, on the payroll side, where I like to start with it is I like to start with kind of a combination of a couple things. One of them is asking the owner, so how often is it attended and how much do you pay your people? And I will write that down. If they're open 7 a.m. to 10 p.m., but they're only attended from 10 to 7 every day, okay, that's 9 hours of payroll. And I will just extrapolate, okay, what days are you closed per the year? Oh, we're closed for Christmas and Thanksgiving. Okay, so 363 days a year, you're attended from 10 a.m. to 7 p.m. Are there exceptions to that? Well, no, not really. Every once in a while, somebody calls off. Okay, so I'll factor in a 2% whatever. And then I say, well, how much do you pay them? Oh, well, we pay them $15 an hour. Okay, well, I know $15 an hour isn't actually $15 an hour. It's probably more like 16 or 17. Oh, do they get bonuses? Do they get drop-off bonuses or all the different things that we pay? Oh, no, we don't do any of that. Okay, fine. And then I'll just simply do some basic math and I'll say, okay, well, 363 days a year, they're attended 9 hours a day, and they're paying an average of $17 an hour for payroll. And that amounts to, I don't know, whatever that number is, $60,000. And then I'll look at the payroll and be like, oh, look, payroll's $60,000. Okay, well, that's good and that's bad, as Carla mentioned. Why is it good? Well, it's good because they're probably actually paying people 10 to 7. They're probably actually paying them $15 an hour, and that maths out. Why it's bad is because that isn't all the things associated with running a laundromat, right? So the next question would be, so who fixes a toilet when it breaks? Oh, well, I call a plumber. Okay. Who fixes this? Who fixes that? Who paints the store? Who locks up at night? Who does this? It could be all contractors. It's possible.
It might show up in the repair costs instead of the payroll.
Right. And what we're typically the most misappropriated line item or disappearing line item, I guess I should say, is the owner's work. That's the most common thing, which Carla touched on. They're usually doing the job of several tradespeople, doing their own bearing jobs, fixing their own equipment, fixing the toilet, doing hundreds of dollars an hour in electrical work or whatever, pretty common for handy people, and they're not paying themselves a salary, right? So once again, if back to this number, if we have $100,000 net operating income, and they say they're making $100,000 a year, but the truth is they're doing the job of somebody that's a $100,000 a year employee, but they're not paying themselves a $100,000 a year salary, then the truth is this ain't a business, this is a hobby, right? This is a job is what this is, and it's a six-figure, $100,000 a year job, but the business doesn't actually make any profit because that owner isn't going to come along and work for you for free and do all those things for free. Now, full disclosure, some people, when they buy a small business, understand that they're buying a job. They're not actually buying a business, and they're okay with that. A lot of people actually think that's the way the world works. It's not. But if you agree to it, I mean, who am I to tell you that you can't do that?
Or and maybe you're fine buying a job, but you're going to grow it into something that's not possible, a job.
Has more
which
potential.
Is one of the later things we'll talk about.
For sure. But that doesn't mean it's worth 5x of NOI because there is no NOI, right? Now, you can pay whatever you want for a business. Don't let us sit here and tell you what to do or what not to do. But that's not how bookkeeping and accounting works, right? Now, if they say, this is very common too. Oh, the wife is the manager, right? The wife does all the drop-off. She manages the 2 or 3 drop-off employees, and the husband does all the mechanical work, and they clean together, and they have a couple part-time people that help them out. Okay, well, now you could potentially have 2 people that should be being paid a $80,000 salary that aren't being paid anything. And this business could actually be losing money, right? Because the old law is in business, if you're not going to do it for free, then I have to pay someone else to do it. And that's a difference in a business and a job. If I'm doing $100,000 worth of work, and I'm paying myself a $100,000 salary, then that's a job. That's different than owning the business. And if above and beyond that, the business makes another $100,000, then that's the net operating income of the business. But that's not a lot of times what happens. And these aren't even really, honestly, I think most laundromat owners don't even know and understand these things. So I don't think it's necessarily anything nefarious they're doing. Most laundromaters I know, they're selling their businesses. That's how it was run before. That's how they run it. And they're like, oh, yeah, I make $100,000 a year with owner withdrawals, right, in exchange for my work. And once again, if you're happy with that, that's fine. But that's not a business that makes $100,000 a year. So those are the type of nuances that we're looking for in the business. A lot of the other stuff is you're going to get bills for, right? So it's pretty self-explanatory. And if they're doing payroll through ADP, you can ask for payroll reports, right? That kind of confirm they are actually doing these things. Where we get in the gray areas, oh, well, I pay that person by the side, or I pay a minimum wage, but then I give them a $300 a week bonus in cash, wink, wink. So I don't have to pay as much payroll taxes and workers' comp and things like that. So, I mean, there's a lot of wink, winks that happen in there. And within those, you have to decide what you're comfortable with and what's reasonable.
Whether you already have a laundromat or are looking to get into the laundry industry, everyone needs proper drainage. We use HM Company drain troughs. Their drain troughs were first created in 1991, and they have been the leading drain trough manufacturer ever since. They're made in the USA, and their drain troughs are fully customizable to meet your needs. That's why we've used them ever since entering the industry. They're easy to clean for our staff and plenty sturdy when we need to walk on them when servicing our washers. With the ability to span up to 25 feet, our troughs rarely need to be connected together, creating an easy installation. Want to slope your trough like we do? No problem. Just let the experts at HM Company know. For more information, go to their website at draintroughs.com. That is draintroughs.com. HM Company Drain Troughs. They've been leading the industry since 1991. Check them out today. All right, so step 2, the next thing you want to do, so after you've dug into their financials, next thing you want to ask for is a copy of that lease. And laundromat leases especially are very, very important.
Oh, yeah.
What is it? You can't escape a bad lease. What's that saying? The people always say in the laundromat industry.
Yeah, there's a couple different sayings, but one of the most common ones is the only thing you can't escape in the laundromat industry is a bad lease. Mm-hmm. Like, you can't typically fix it. Now, our industry is changing where, when self-serve, your demographics are demographics. And where that came from is 20, 30 years ago, there wasn't, drop-off laundry existed, but it wasn't as prevalent and as profitable. Pickup and delivery wasn't a thing. Even drop-off dry cleaning wasn't as common. Now there's ways to kind of escape bad leases, but I'd rather you not be in one to begin with.
Well, too, the equipment is expensive to move, and then you have the whole infrastructure. I mean, there's a lot of investment that you put into making that space a laundromat, with the plumbing, the electrical work, the HVAC, like everything is different for a laundromat than for any other business. Yeah. So you really need to think about that. So what are some recommendations that you have for what, and I know we've done a whole podcast on leasing, on leases and what is a good lease. But real quick, what are some recommendations you have for a good lease?
Well, one of them is I would recommend having a business attorney that specializes in commercial leases look at this lease. Now, they're not going to understand the nuances of a laundromat lease, there are some unique differences, but as a general rule, that's a pretty good rule of thumb. Pay them $1,000, whatever they charge, to review that lease. Ask them for them to point out the red flags and red line things that they find as issues, right? So that's the first thing I recommend people doing. Once you've done that, then either hopefully you have experience doing this, or you can find a coach or a mentor or someone that can help you through the process of some of the nuances. But some of them are things like the operations of the business, right? Some of commercial leases from the landlords are typically very vague, right? But a lot of times they'll sneak some of this, fine print into them of things like, oh, you can operate a retail laundromat, but no other associated services. Well, what does that mean exactly, right? Well, do you want to go to court and argue it over and get in a lawsuit and figure it out? Well, how about we just define what that exactly means? Mr. Landlord, what's your concern? What are you worried that I'm going to do? Oh, well, I don't want you to fill up the parking lot with pickup and delivery vans. I've heard laundromats do that. Okay, so you're wanting to exclude me from pickup and delivery? Well, that's a pretty important thing. I'm glad I know that because I'm going to do pickup and delivery. And so we got to solve this problem right now before we sign the lease. But when it comes to due diligence, there's a couple phases to it. One of them is you want to review the lease that you have, right? Or that the current owner has. So you want to get a copy of that lease and review that lease. That's like a floor. That's a starting point. And then typically, if that lease is assumable, you can easily assume that lease. If it's not assumable, then you need to go and negotiate a new lease yourself. But the thing I like to point out to my coaching clients is, if you're in the process of due diligence and you're considering buying this laundromat, the truth is you haven't bought it yet. you're probably going to buy it and turn it into a better version of what it is right now, which means you have all the leverage in the world. Right? You will never have more leverage than you do right now because you have the lever to pull, which is walking away. Right? So whether you're trying to assume a current lease and maybe you just want to add an addendum to it that clarifies a few things, you can do that and make sure the terms are correct and et cetera, or you just go in and be like, look, this isn't going to work. We got to blow this up. We got to solve all these problems right now. And if that happens, that should be done in due diligence and it should be done. You should be signing the new lease simultaneously with the closing of the business. You shouldn't be typically signing it early. What if the closing falls through, right? You want to do simultaneously things and at the same attorney's office if you can a lot of times. So those are some of the things to consider. There might be some things that I'm forgetting in there. Of course, I recommend that, if you're acquiring the business, I assume you're in this for the long term. So a lot of them are things like, hey, we want to have a 10-year option or a 10-year lease up front, and then we want to have a minimum of 2. I prefer 4 5-year options. I'd prefer for this to be locked up for 30 years. Once again, whether you're negotiating a new lease or you're assuming their current lease, another thing you want to consider is things like the rate terms, right? So, okay, I have a 10-year lease with 4 5-year options, and it says my rate is $200 a month for the first 10 years. And then for all 4 5-year options, it doesn't make any decisions around the rent I'm going to pay. It just basically says, oh, we'll figure it out in 10 years in legal terms, right? That actually exists. That's in leases all the time. I've seen in laundromat leases, it's actually not uncommon for a laundromat to be in a strip center with a, around here they call them Dairy Marts or Ameristops, but a convenience store or gas station of some type. A lot of the times the property owner owns that business. That's kind of their anchor tenant, the gas station, whatever you want to call it. And a lot of times they'll sneak into your lease that you can't sell any products over the counter. You can't have any vending. So is that going to make or break your business? Probably not. But would it be nice to know that I can't sell soap and I can't sell laundry bags and I can't sell Pepsi and I can't sell Snickers? I literally can't sell anything at a vending machine. I can't sell anything over the counter. A lot of times the lease has limitations on gaming systems, very broad terms, which means I can't put in an ATM in theory, depending on how it's worded. I can't put in coin pushers. And once again, are these going to make or break your business? Probably not, but they can take a good business and make it a great business. And a lot of times they'll have exclusions around specific things like ATMs and things like that, because they want you to drive all that traffic over to their business or to a partner's business. So when you're looking at a lease, like I said, there's really 2 ways to look at it. One of them is through the lens of the current lease. And if I assumed that, what am I looking for in that lease? That's kind of my floor. And then I'm typically going to negotiate either addendums to clarify things in that lease, or I'm just going to try to negotiate a whole new lease, tear it up, and start over from scratch. And by the way, this is a really good opportunity for you to find out what kind of a landlord you're going to have, because you're going to find out real quick, oh, they're perfectly reasonable. They want you to be profitable and successful. They just want you to pay rent. Or that's not their approach and they think you're the enemy. Right? Those are kind of the 2 extremes.
But warning, they can always sell the business. So sometimes your landlord changes.
Of course, that happens too. Absolutely.
So don't get too attached to one landlord.
Yep, for sure. That happens. Absolutely.
All right.
But the lease is important. It's something to look at.
Yeah, definitely. So then number 3, taking a look at the equipment and inventory. You really need to know what you're getting, basically.
Yep.
So a big expense of laundromats is that equipment. And so what shape is it in? Are you going to need to do a complete retool? Has it been taken care of? How old is it? How well is it running? Has it been maintained? And then also your inventory. What else comes with that? Like, it's not just the equipment, it's the folding tables and even, the laundry bags. It depends what all they're including in the sale. For
sure. When it comes to the equipment and inventory, I want to share with you like a little horror story here that didn't end up being a big deal, but our first store that we acquired, of course, I didn't have experience in this business, and we itemized the washers and the dryers. We had serial numbers, and mainly because I didn't know to do that, but our equipment company made us do it, or the financing company made me do that to get the SBA loan. But we didn't itemize anything else. And we walked in there, and every broom, every dustpan, every cleaning rag, every soap bottle, I mean, the folding tables and chairs and stuff were there, which they actually weren't itemized either on the inventory list. They could have taken those. But if it ain't written down, down, it didn't happen, right? So this is a legal agreement. When it comes to equipment and inventory, you want to confirm that when I make this offer of $500,000, I'm buying everything. And during the due diligence phase, you want to itemize every one of these things, and that needs to be a part of your purchase agreement. The day of closing, you should typically meet at the store a couple hours before closing and go over your equipment list, your inventory list, and verify that every broom is here. Verify every one of those things. All the tools were gone. I mean, every extra part for the machines was gone. Now, a lot of this stuff I didn't want, but trust me, we were on a budget, Carla, and I had to go out and spend thousands of dollars on brooms and dustpans and cleaning supplies and shelving. They took all the shelving from the back rooms, and I'm just like, well, I'm buying the business. Of course that's included. It wasn't written in the contract anywhere, and I called him, and he was like, oh, Dave, I'm sorry, misunderstanding. So the equipment and the inventory, don't take that lightly is my point. The odds that they're going to take an 80-pound washer out probably aren't really high, but let's make sure they don't take the 80-pound washer out too. But I mean everything. If it's important to you, every little screw should be itemized if you want to get down to that level. And if you don't get down to that granular level during due diligence and verify it right before closing and have it inventoried on your purchase agreement, then be prepared for it to not be there. Part of due diligence is just verifying what you're buying. To just say I'm buying a business doesn't work, right? Contractually, legally, it doesn't work.
Do you have any recommendations, like, should you go in before you close and, like, try to run every single machine? Because, I mean, technically, they could have it not marked out of order, but they could all be out of order if you don't test them or try them. I
mean, you decide how far you want to go with it, but I've seen many purchase agreements that states that all the washers and dryers must be in running mechanical, good mechanical working order. So if you wanted to verify that, technically, you should not only go in and run them, but you should actually go in and put laundry in each one of them a couple hours before closing. And it's very common, by the way, to have a closing in the afternoon at like 4 o'clock for a business. And the reason is, hey, we're meeting there at 8 a.m. and we might spend 5 hours verifying this washer works and this. And by the way, sometimes that's why these closings don't make it to closing. And sometimes it's thousands of dollars, sometimes it's hundreds of dollars, and the whole deal falls apart because of it. But I always say when you get to closing, just have a very clear understanding legally of what you're purchasing and what you're not purchasing. And if it ain't in writing, it didn't happen.
Okay, so after the equipment, number 4, understanding the customer base and the revenue streams that store has to offer. So this is obviously understanding the customer base. This really gets into the demographics around your store. Who does that laundromat currently serve? Who are their self-serve customers? What's nearby? Like, basically, how valuable is that location? If the demographics are off the chart and maybe they're only servicing 25% of them, but if you improve that store, you're going to be able to service so much more because the demographics are that good around it. What are the current revenue streams? And this gets into one of our later, but what other potential revenue streams can you even add based on those demographics?
Yeah, I always say what I'm paying for the business is based on the condition it sits in right now and the revenue that it generates as it sits here. That's what I pay. That's how I value it. If we make up that $100,000 number, it's worth $100,000. But typically, I don't buy a business to run it the way it's run right now, right? I typically value it based on what it makes right now. But I'm typically the yes or no binary question around whether I want to buy it for that $100,000 multiple is based on the potential of what I think I can turn it into. The $100,000 is the floor. If I run it like you, I'm going to keep getting $100,000 a year. But I'm somewhere between there and, utopia is where I'm going to try to get of what I think I can turn this into a $200,000 business. And understanding the customer base and where the revenue comes from, one can be part of verifying your revenue. Okay, well, I know I'm getting 4 turns a day, and I know I have 2 80-pound washers that are $14 a piece, and you can kind of reverse engineer and extrapolates out, okay, that kind of lines up. These can be kind of checks and balances, but also understanding the customer base a lot of time understanding the potential. And a lot of times that's not factored in the equation. That's what we call value add. That's opportunity, right? And that's the reason that we do buy it. The last thing I'll throw in there that didn't used to be as relevant, but it is nowadays that I would put in there is the customer data, right? If they have a Google business profile and they've claimed that, they need to turn that over to me. They need to give me ownership of that. Any of their social media pages, they need to give me ownership of that. The day of closing, before we close, any email lists. text list, any type of customer data, understand what the float is, have negotiated the float. The float can be 6 figures sometimes in a card store.
I think you might want to expand on float because with the loyalty card systems, float can be an essential part of the negotiations as well.
Huge.
So talk about float.
Well, basically all float is, if you have a card system or even an app-based system, a customer puts $50 on a card or $50 on an app, and maybe that day they spend $25, and then they leave, and they go home and they go about their life. Well, you have $25 of float. It's the difference in what they put on the account that day and the difference in what you have already redeemed to them, right? And it doesn't sound like a lot, but in smaller volume stores, the float can be $20,000, $30,000, $40,000 over the course of several years. It doesn't happen in a week. In higher volume stores, it can be $200,000, $300,000 in some cases. And so who gets that float? Who has the liability of that float, right? Because you're buying the liability of it. Well, he already spent the money on a yacht or whatever, right?
Basically, think about it. You're going to buy that company. If you don't think about the float that's out there at all, you could have a bunch of customers coming in and using your machines and not paying you anything because they already paid the previous owner.
That's
right. So you really need to think about that.
And that's usually on most card systems or app-based systems. It's a very simple report that you need to run. But Carla is exactly correct. This is a big portion of negotiation. And if it's a lot of money, a lot of times these people just assume, oh, well, I'll sell you the business for $500,000 and that's 5x of NOI, which is $100,000, and they just never bring up the float, and they're over here going, well, yeah, that $300K I already spent, right? Well, if there's $300,000 in float, that's a liability, right, on me. So if I'm going to take on that liability for you on the books, then I need to be compensated for that. Right. And so if I'm paying you $500,000 for this business and you have a $300,000 float, I'm now paying you $200,000. And holy cow, do people sit right up in their chair real quick and things get really ugly really quickly because they just never thought of that. So I don't know that it really factors into,
that
customer.
Almost is more maybe
it's
with the
around
financials.
The customer data. Yeah, it's probably more around the financials and the bookkeeping and things like that. But I was referring to customer data, and that's kind of how I went down the float rabbit hole. But it is something that's really important. It's a big part of due diligence, and it is definitely not something you want to take for granted. Because once again, you could be paying $800,000 for a business that you thought you were paying $500,000 for, and man, that really changes the game.
Would you like to make more money from your laundromat? Would you like those machines you're paying for to have more turns per day? Do you offer wash, dry, fold services or pickup and delivery laundry services? If not, would you like to? Whether you do or not, we have an amazing opportunity for you in Cincinnati, Ohio.
Yeah, you've probably heard about it, guys, but it's our wash, dry, fold, pickup, and delivery workshop. And to answer your first question, yes, it is for drop-off laundry, wash, dry, fold, and pickup and delivery. So if you're doing any of those things, this workshop is going to help you tremendously. But the truth is, we were pretty so-so laundromat owners and so-so successful until we launched drop-off laundry and pickup and delivery. And being able to what I call optimize your laundromat to generate more profit and more revenue out of the existing facility, that's the key to taking your life from good to great, financially speaking, with laundromats. And that's what made us Laundromat Millionaires.
You don't have to just listen to us. Listen to what some of our past attendees have to say about our Wash, Dry, Fold Pickup and Delivery Workshop in Cincinnati, Ohio.
It was the best workshop I've attended in over 25 years. And what you guys have put together is nothing short of phenomenal. I think that you guys have put together both strategic and tactical systems that will make an individual who wants to own the laundromat profitable within months, not years.
Was the workshop worth the investment? Without a doubt, it was definitely worth the investment. So not only did we have two very packed days with Dave and Carla and their team, both in the classroom and touring the facilities, but we also came away with this extensive 100-page handbook. And then after the workshop was completed, I received a bunch of electronic performers and templates that we've been able to use since the workshop. Every day since the workshop, I found myself referring back to either those electronic tools or the handbook that we received. So,
was it worth the investment? Absolutely, absolutely, absolutely. I cannot say that enough. This was such a blessing, and I am so very grateful that Dave and Carla put this together and are sharing their knowledge and experience with others to have this to grow their business and to become more successful. Thank you, guys.
So are you interested? Go to laundromatmillionaire.com to learn more and see where you can register.
All right, so number 5 is looking at the current operations and how well the store is functioning. We recommend actually shadowing, like actually visit the store during a few key times, like maybe, check out what's the flow like, what are the operations like on a busy Sunday, on a dead Tuesday or Wednesday. One, that's going to give you some idea of how accurate their numbers are. If they're saying that they're doing 4 turns per day and you walk in and they're dead on a Sunday, that's probably not a good sign that they're being honest. So one, for that accuracy, but also to see some ideas for how you can improve upon it or some possible issues in their operations and in their throughput, their workflow around their laundromat.
Yeah, the thing about this, though, is it's really tricky because remember earlier when I mentioned that the owner of the business doesn't typically want their employees to know? This can be a really sketchy situation. Even in due diligence, they typically won't let you do that.
Couldn't you just go in and pretend you're a customer?
You can. That's what I was going to say.
Okay.
Is if they won't, I prefer to do that because I actually place tremendous value in the operations and the culture and the employees. If you got a team of rock stars, you got 20 rock stars in this place, that business is worth way more than me than it is if you got 20 toxic people in here. Or God forbid, you don't have any employees, you have illegal employees or whatever. That's a big importance to me. Now, I'm still going to turn it into Queen City Laundry, but if I'm 80% of the way there, that's a lot easier journey for me. But Carla is exactly correct. The odds of them letting you do that are very slim. I'll tell you right now.
And maybe they'll be more likely the closer you are to the very end of due diligence.
There are some people that'll be like, hey, if we get...
It's almost closing day.
That's right. If we get 3 days out, you can go in and talk to them and do some last-minute due diligence, and you try to have everything else done before then. But Carla is correct. More often than not, you have to do 007, and you got to go in there and you got to pretend to be a customer. And, I teach a lot of my coaching clients how to do this when it comes to competitive analysis. Going in and doing laundry. We have a checklist on our website that's free to download. Download that and, make observations. Just pretend you're a customer. And there is a lot you can do, but you do have to be kind of sneaky and coy about it, which I'm not a big fan of, but it is a part of the due diligence process. So just understand that. Don't be surprised if that's a no-go for them. If you talking to the team and telling them they're selling, that's a big no-no in the world of selling businesses. So just keep that in mind.
All right, so the next one, number 6, you've kind of hit on a little bit, that competitive analysis. So make sure not only do you know what the store is truly like, but what the competition around them is. And this is part of, too, why you like to see that 3 to 5 years. Are they suddenly experiencing a dip because there's a new store that just opened up down the street? Or maybe they're selling because they just heard a new laundromat is opening up down the street. So make sure you're aware of those things that could be affecting their business negatively, whether they're already affecting it or going to be soon. And as Dave mentioned, he often recommends actually going to the competitors' businesses, actually doing your laundry there, see what they have to offer. How does the store you're looking at compare currently? And imagine how will it compare once you have it? What are maybe the value propositions that you can add to the location if you acquire it?
You would be shocked how much attendance will tell you. Like, if they're not properly trained and they're not trained to act as a gatekeeper and the things that we do at our businesses, some places are just a free-for-all, and you walk in and, they will tell you all kinds of stuff that you're just like, and you would never believe it. Now, you don't know whether it's true or not. It's just one disgruntled employee, but they can be a great resource in that way. Another thing I'll tell you, when Carla mentioned a new store is coming in, part of this category of due diligence, competitive analysis, is also going to, in Ohio, we call them counties, but whatever your municipality is, going to the county building office and asking if anyone's pulled permits to build a laundromat within this county. Because if they've started the process and they've pulled a permit, that's public record, and they have to tell you who that is, and they have to give you that information. It's entirely possible somebody just pulled a permit yesterday, and that store ain't going to open for a year, but the old owner caught wind of it, and if you didn't go down to the county office, you would have never known it was coming. It's not like they already started construction. They might not have even bought a piece of property yet, or maybe they just bought a piece of property. So like, these are all things to consider in the due diligence. You decide how vigilant you want to be, but I can tell you that the more money you have invested in this project and the more risk there is, the more hyper vigilant you should be.
All right. So number 7, this is one that early on we did not think about at all, but we've had friends in the industry where this has hit them hard, and that is regulatory compliance.
Yep.
Watch out for those potential lawsuits if the store you're looking at is not complying with different regulations. The one we've seen a lot is ADA compliance. So things like, if it has a bathroom, is that bathroom ADA compliant? And if it isn't, then you have to factor in the adjustments you need to make to it to make it ADA compliant, or you could be risking thousands of dollars in lawsuits. Also, the changers have to be ADA compliant. I know we're currently adding Laundroworks to all of our locations, and we have to make sure that one of those kiosks at least is low enough to be reached by someone who is in a wheelchair. ADA compliant, the actual dryers and washers, all those types of things. Any other issues you can think of with regulatory
compliance? No, the ADA
compliance
is a big part of it. The only other thing that I guess our industry, the good news is our industry isn't overregulated. There are some industries that are insane. Our industry is probably on the easier end of that, but that doesn't mean you should take it lightly. Like, look into these things. What are the regulations? Talk to your county office, your state office, talk to fellow laundromat owners in other states. What are things I'm missing? But there really shouldn't be a whole lot out there. One thing I will tell you, a mistake I made is I had someone in the industry that clearly didn't know what they were talking about tell me, oh, well, if you buy a business that was built before 1972 or whatever, it's like they just made it up. Oh, you're grandfathered in. So your bathroom, unless you do this, this, and this, it doesn't apply. You are not grandfathered in. I'll tell you, it's a federal law. You are not grandfathered in. You have to be ADA compliant. And we ran stores for a decade that were not ADA compliant, and we thought we were grandfathered. So now we've been spending money, tens of thousands of dollars, remodeling bathrooms and putting new ADA compliant doors in and ramps and different things like that to get compliant. And it's not going to probably make or break you, but nobody wants a $10,000 lawsuit.
All right, so number 8 is legal obligations. You definitely want to look in, see if the current business has any pending lawsuits out there, or any other things you might be assuming for them.
Yep. Yeah, the biggest part of this is it's actually, in my experience, I'm not an attorney, full disclosure, but in my experience, it's not super difficult. It's just, if those exist, you have to write your purchase agreement and your contract that you're not responsible for those things, right? If ABC Laundromat LLC is being sued for whatever slip and fall, well, you just don't buy ABC LLC, right? You don't buy the company, right? As long as you don't buy the company, you should be excluded from that. But of course, run this by an attorney. You can just make an asset sale, right? I'd just purchase and washers and dryers. I wouldn't assume the lease under that company's name. I would sign a new lease, right? Obviously, consult an attorney. It can be big stuff, like lawsuits could be really bad, that are pending for years and years that amount to hundreds of thousands or millions of dollars. That's like one extreme. The other stream is they signed a 3-year contract with their local equipment distributor to do all their maintenance and service work. And you don't like that distributor and you don't want to do business with them. Well, you should make sure that you are not liable for that legal contract, whatever that takes, and talk to an attorney about that. But hopefully those things don't exist. But one of the things that I recommend you doing is whoever their current vendors are that they're used to doing business with, when you're buying a turnkey store, I want to find out who they are. I want to find out that they're not 6 months behind on their service payments, or they don't have some side note with the distributor personally guaranteeing it or something like that. These are all pretty extreme situations, but they definitely happen, and it's just better to, once again, the reason due diligence exists, go down these rabbit holes, dig into these things, and then, of course, talk to an attorney and structure your purchase in a way where even if these existed and we didn't know about them, that you wouldn't be personally liable for them. Both of those things are possible.
All right. So number 9, their marketing and branding and just their overall reputation. Dave kind of already hit on this earlier about with the Google business profile and their Yelp. Make sure you get control of those accounts. And it might be, if their reviews are that bad, you might need to even appeal to those to shut down that you have a new owner and develop a new account, like start from fresh. But definitely get a feel for the reputation of their brand.
Yeah, what I always tell people is typically in the due diligence phase, I mean, when you made an offer, these things are pretty obvious, right? Generally speaking. So like you look at the reviews and they're horrific. They don't have a brand. They're coin laundry, right? Or whatever. I mean, these things are usually pretty obvious. But if you are purchasing things that are very valuable, like you are purchasing the brand and it's a turnkey store and it's very valuable, they could have that brand trademarked, right? Okay, well, you're purchasing the business. Are you getting the rights to the trademark? Oh, well, they have 3 other locations. No, you're not getting the trademark. You actually are writing in your contract, whether you know it or not, within 30 days of closing the store, you have to change the name, right? And these are a lot of those things that kind of get sometimes intentional, sometimes unintentionally, get kind of slid into the situation. And then once you close, you get an email the next day that says, hey, make sure you order your new sign. You got 30 days to take down the Queen City Laundry sign. You're like, what? Wait a second. And they never even brought it up to you. And then they send you a cease and desist letter or whatever, and it gets really ugly really quick. So these are just better things to confirm. Hey, I'm buying this. I have the rights to this. Is Queen City Laundry trademarked? If it is, if that's a valuable part of the purchase, just make sure it's very clear in your paperwork, just like the equipment and the inventory. Don't take anything for granted. I'm telling you, every little screw. If it's important to you, make sure it's in writing. Just know what you're getting into. And some of these things I've been burned by. So it's why I want you to know these things.
All right. So number 10 is the insurance coverage. And just a little plug here. You can always go to laundromatmillionaire.com/insurance for the Laundromat Millionaire Insurance Program, and they will help you get the coverage that you need. So what do you need during due diligence? What do you need to know about their current insurance? Because I assume you change all their insurance when you buy something, right?
You're going to change the insurance. Honestly, the biggest thing is just make sure you have coverage before you close.
Okay.
Right? You're not going to inherit their insurance. You're not adopting their insurance, right? It doesn't come with the deal. And it's one of those things that most owners know that, but they don't think about it. They go through due diligence and they do all these other things that, tax returns and all this makes sense, but they forget about. And I know people that have bought a laundromat and run it for 3 or 4 weeks and been like, oh, wait, I never did anything. And they're uninsured. They're running, and sometimes $1 million business. They've been running it for 3 weeks. No insurance on anything, their equipment or anything. And then obviously it goes to say, but if you're going to make sure you have proper coverage, I think it's good to ask for their current insurance policies. They don't have to give them to you, but I like to use that as a baseline. Now that we have our insurance,
their policy was enough though.
No, they don't. But use that as like a checklist, for lack of a better term, for your policy. Their policy has nothing to do with you, but especially if you're not working with an experienced laundromat insurance broker that's insured thousands of locations, they might not always understand the nuances of insuring a laundromat for liability purposes and for equipment replacement purposes. Yeah. So once again, it is an urgent thing, but it's something that's often overlooked as not part of due diligence. So as Carla mentioned, the reason we created the Laundromat Millionaire Insurance Program is because we don't think there's enough knowledgeable brokers out there that are doing this and writing policies the correct way, the legal way, the accurate way, and making sure we're properly covered for a competitive price. And that's why we started the program. Our insurance brokers, our partners in the program, they'll review all of this for you for free before you even close. Just contact them, send them a current policy, let them know what you have, let them know what you're planning on doing. They can see these things coming a mile away. Have you thought about this? Have you thought about that? So it's something that's important to do during due diligence, is at least make sure that you have proper coverage on day one.
All right, so number 11, we're getting near the end here, and Dave kind of touched on this a little bit already, the employees. Yeah. When you're buying a business, you might be buying a whole team of employees with it. That sounds bad, like you're buying people, but you know what I mean, assuming they want to stay with the company. Yeah. So definitely you need to be assessing what the current employee status is. Is it a positive employee culture? Are they hard workers? Or can they at least be trained to be hard workers?
What is their legal status, right? And I don't mean legal or illegal. I mean, that's a part of it. But I mean, once again, depending on how you structure this deal, if you buy, my analogy earlier, if you buy ABC Laundromat LLC, you're now responsible for those employees. Like, you're taking over ownership of those employees, meaning if they've been there, I don't know if you're in a right to work state or not, and all these different factors that go into it, but you're now legally responsible for them. You can, let's say you go in there and you're like, oh, I'm going to be unattended, and so I'm going to fire all the employees. Well, you don't want to fire the employees. You want to write a contract and make sure you're not ever responsible for the employees. And when the owner closes down their LLC or their company, that they just dissolve the company and the employees no longer have a job, and it's their legal responsibility. You don't want to take responsibility of employees that maybe worked there for 20 years, right? Depending on the state, that can get really sticky. Some states, not so much. But a lot of it's just around the structure of how you're buying it, and an attorney can help you with these things. Like I said, if you typically structure as like an asset sell or something like that, like I'm buying this inventory of equipment and I'm signing a new lease in this space, but ABC Laundromat LLC, I have nothing to do with. A lot of it's just structuring the deal in that way to kind of have a very delineating line. And that's what our attorney has always recommended. Now, we've never really bought I've helped people do it, but we've never bought turnkey stores that had too much valuable assets. But one thing I do want to point out when it comes to employees in the due diligence phase that I kind of touched on earlier is just the value proposition associated with them. If I can recognize, if I were to ever buy a turnkey store that was like a chain of Queen City laundries, I mean, there's so much value in our team. If somebody bought our chain of laundromats, it'd be through the roof. Like, obviously, I want to handle that situation very differently when I'm going to come in and be like, hey, the day we close, I want you to fire all those people. I don't ever want to even see them again. You may be at one end of the spectrum or the other. Just make it very clear between you and in the legal contract what you're doing.
Yeah, and that's really the point of this section of employees is one, a really good group of employees might increase the amount you're willing to pay for that. Like maybe based on its net profit, you're willing to pay $100K, but you're also going to be getting this wonderful team of people. So you're like, okay, I'll pay 110, 120, whatever. Or, you don't want the team that comes with it, so you're staying at 100. So it affects that, not just your legal obligations to that as far as what's written in the contract, but also maybe what you're willing to pay. Which takes us to actually the last one. And I think this is probably one of the biggest that affects what you're willing to pay for that location. And that is its future growth potential. Maybe, this laundromat is a zombie mat and it's not making much money. And based on its net income, you're only willing to pay, it's only worth $20,000, okay? Because it's a zombie mat, it's barely making ends meet, it's not worth much. But its demographics are through the roof, and it has a great floor plan, and you are going to completely renovate it, and it's going to open up so much potential for your other future revenue streams. It has a great spot for pickup and delivery and wash, dry, fold, or whatever. You see that future potential in it, and you might still try to pay the $20,000 because that's what the financial statement says it's worth, but you might be willing to stretch that up to 40, 50, 60 based on that future potential you see in that.
Yeah, and that's a you thing. I mean, you decide what value you put on this, if any. But for those of you that have read my book, you've read a story that our third store that we acquired, I almost walked away from. And I would have been right, and I also would have been stupid to do it at the same time if I hadn't got good mentor advice from my mentor and my attorney. Because the truth is, the business was actually profitable. It didn't make a lot, but it made a little. It had a little team in place. It was probably the nicest store we had ever bought, even though it was nothing special. And the owner wasn't willing to sell it for nothing. I forget what the numbers were, but I want to say it was around $120,000. And I did the math, and all of a sudden, extrapolate this, carry the one, and all this stuff. And I was like, oh, yeah, there's no way this place is worth more than 80, and to turn into a Queen City Laundry, I'm going to have to borrow all this money. And by the way, my math, I was right on all that. And I think the numbers were 80 and 120. He insisted, he had asked 180 and he had come down to 120. And he was basically willing to let me walk over that 40. And I was willing to pay 80, but I was not willing to pay 120. And my mentor looked at me one day and he was like, tell me about what you're going to turn this into. Because, of course, he already knew all this. Oh, we're going to do this and we're going to do this. And by the way, long story short, this is a store that got us to do wash, dry, fold and eventually pick up and delivery. We had never done it before and probably wouldn't have if we didn't buy this store. Talk about life altering. And long story short, I was basically willing to walk away over $40,000. And I talked this through with my mentor and he was like, tell me about what you're going to do and, the pro forma and what you think it's going to generate and your new equipment. And now you're going to be attended and you're going to do, oh, by the way, we're buying the building too and all these different things. He's like, how long you plan on owning this? Oh, 40 years. And he's like, so over the course of those 40 years, what do you think that $40,000 extrapolates out to per year based on the difference in where it is now and what you do to it? And we had a little 10-minute conversation. And the truth is, we were both right. Like I was right. As I sat there today, it was only worth 80. But he was also right. Over the course of 30 or 40 years, overpaying for the store by 40 grand would have been one of the smartest things I could ever do in my life. And it has been one of the smartest things I've ever done in my life. And it would have been one of the dumbest things I'd ever done to walk away over 40 grand. So I'm not here to tell you that you should make decisions based on that. That's my personal choice, but you should understand the dynamic, understand the situation you're in, understand the opportunity, what you're going to turn it into. It might only make 20 NOI right now, but you might be an experienced veteran and buying that store and it's going to do 200 in 3 years.
So we've done all 12 of our steps of due diligence, but the little bonus here is a great way to get help on all 12 of those is to find a good mentor, consultant, coach, somebody who knows the industry that can help you through all those steps, help you see what you should look for. What are the red flags and what are the aha moments like, does 40K really matter? Is it going to be worth it in the long term? So definitely too, if you are struggling with due diligence, look for those people out there in the industry that can help you out. So those are basically our 12 steps for due diligence to help you find that perfect deal for your first laundromat or your 12th laundromat, wherever you are in your journey. But remember, wherever you are, we would love to help you. So check us out at laundromatmillionaire.com. And this is the end of this episode 100. Sponsored by HM Company at draintroths.com. We'll see you next time. Take care.
Thanks, everyone.
So those are our steps for due diligence. So, okay. All right.
You're almost there.
I
You're
know.
almost home.
I know. But those are basically our 12 steps for due diligence. But those are basically our 12 steps for due diligence.